Not long ago, the easiest way to win in business was simple: be cheaper. Lower prices, bigger discounts, better deals. That's how companies attracted customers and grew fast. If you could undercut competitors, you could capture market share. But that strategy is fading. And in its place, something very different is taking over: premium pricing. Across industries in the US, companies are charging more, not just because costs are rising, but because their entire strategy is shifting toward higher value, higher margin business models. And once you understand why, you start to see it everywhere. This is why premium pricing is taking over the US market. The first reason is simple but powerful. Costs have changed, and they're not going back. Labor is more expensive, materials cost more, logistics are more complex, energy prices are unpredictable. Even compliance and regulation add to the total cost of doing business. For many companies, the old model of keeping prices low just doesn't work anymore. If they keep prices down, they squeeze their margins. If they raise prices, they risk losing customers. So instead of competing on price, they're changing the game entirely. They're competing on value, and that opens the door to premium pricing. Because when a product or service delivers more value, better quality, better experience, more reliability, customers become less sensitive to price. And that's exactly what companies are aiming for. Another major reason behind this shift is margin pressure. In today's environment, profitability matters more than ever. Investors are paying closer attention to margins. Companies are being judged not just on how much they sell, but on how much they keep. And premium pricing is one of the most direct ways to improve margins. If you can charge more per unit, you don't need to sell as much to achieve the same or better financial results. This is why many businesses are moving away from high-volume, low-margin models. They're realizing that selling fewer units at higher prices can actually be more profitable and more sustainable. There's also a big psychological shift happening with consumers. People aren't just buying products anymore, they're buying outcomes. They're buying convenience, trust, status, reliability, and experience. And those things are hard to deliver cheaply. For example, faster delivery, better customer service, higher quality materials, and seamless user experiences all come at a cost. So when companies invest in these areas, they need pricing that reflects it. That's where premium pricing becomes necessary, not optional. And interestingly, many consumers are willing to pay for it, especially in uncertain times. Because when people feel unsure about the economy, they often become more selective. Instead of buying more, they try to buy better. They choose products they trust, brands they recognize, experiences that feel worth it, and that naturally supports premium pricing strategies. Another key factor is brand power. Strong brands have something incredibly valuable: pricing flexibility. If customers believe in the brand, if they associate it with quality, reliability, or status, they're far less likely to compare prices. They're buying the brand, not just the product. This allows companies to charge more without losing demand. And that's why so many businesses are investing heavily in branding right now. Because premium pricing doesn't just come from the product, it comes from perception. If you can position your offering as premium, you can justify a higher price. And that has a huge impact on profitability. Technology is also playing a role in this shift. With better data, companies understand their customers more deeply than ever before. They know who is willing to pay more, what features matter most, and how pricing affects behavior. This allows for more precise pricing strategies. Instead of offering one price for everyone, businesses can segment their customers and offer different tiers: basic, standard, premium. This is especially visible in subscription models. Companies offer multiple levels of service, each with different pricing and features. Customers can choose what fits their needs, and many opt for higher tier options. This increases the average revenue per customer, and again, it reinforces the move toward premium pricing. There's also a strategic element to this shift. Competing on price is difficult. There's always someone willing to go cheaper. But competing on value is different. It's harder to replicate, it creates differentiation, and it builds long-term customer relationships. Premium pricing is often a signal of that differentiation. It tells the market that this product or service is not the cheapest and not meant to be. It's meant to be better, and that positioning can be incredibly powerful. Another important factor is the decline of heavy discounting. For years, companies relied on constant promotions to drive sales, but that strategy eroded margins and trained customers to wait for deals. Now businesses are pulling back. They're reducing discounts and focusing on stable, higher pricing. This shift naturally pushes the market toward premium pricing, because when discounts disappear, the baseline price becomes more important, and companies are setting that baseline higher. But here's something important to understand. Premium pricing doesn't mean overpriced. It means aligned pricing. The price reflects the value being delivered, and companies that get this wrong, those that raise prices without improving value, risk losing customers quickly. So the shift toward premium pricing also forces businesses to improve. Better products, better service, better experiences. Because without that, the strategy doesn't work. So when you look at the bigger picture, this isn't just about prices going up. It's about a transformation in how businesses compete, from cheap to valuable, from volume to margin, from mass appeal to targeted experience. And that's why premium pricing is becoming the dominant strategy. Because in today's market, being the cheapest isn't the advantage it used to be. Being the most valuable is. And the companies that understand that are the ones setting the new standard, one where higher prices aren't a weakness, but a signal of strength.